Hey everyone, hope you're having a good day. My name's Andy. My channel is Finding Value. Today we're going to go through Twitter, see what people are sharing on social media, like I normally do. It's generally related to three different topics: wealth building, commodities, and/or financial topics. So let's dive in, take a look, see what people are sharing. If you want to follow me, it's @Finance. And if you want to join our community, finding-value.com, I dive deeper into all these topics, looking for potential investment opportunities, sharing those opportunities with everyone, going over a variety of different macro events, conditions, technical analysis trainings. We've got a lot of stuff on the website that you can view. We generally have a question and answer session on the weekend, either Saturday morning or Sunday evening. And then I release a midweek update of what I think looks good in the markets. We do have a coupon code special. Special is the coupon code, and you get 50% off the monthly membership for the first month only, and a larger discount on the yearly membership if anyone wants to switch to a yearly membership. All right, so we're starting with Good Morning Liberty, one of Milton Friedman's quotes on tariffs. He says, "We call a tariff a protective measure. It protects the consumer very well against one thing. It protects the consumer against low prices." That's what it protects against. Warren Buffett says, "For some reason, people take their cues from price action rather than from values. Price is what you pay. Value is what you get. Markets are there to be taken advantage of rather than instruct you as to what is going on." And I don't know if he's referring to technical analysis. Technical analysis uses prices and breakouts. I like to see both. I want to see an alignment of multiple things occur, and that alignment is cheap valuations. That's your undervalued. That's the value that you're getting. I want to see the price for that asset be not only cheap, but bottoming out against other asset classes. And that could be a ratio similar like a gold to Dow Jones ratio, or gold to S&P 500, or crude oil versus the S&P 500. Those are all things that you can use to kind of gauge if it's expensive or cheap compared to history. Then you can price the asset in relationship to the commodity itself. And what I want to see is an alignment where all of these things are cheap. I want a cheap asset in financial terms with a asset that's well positioned against the commodity it sells, because a lot of these times the equities are just leveraged plays to the commodity. And then I want to see the commodity to be cheap against financial assets. So that's the alignment that I look for. And we have that alignment right now. We do. Shabam Garg says, "Drill baby drill, moving further and further away from reality by the day, with another massive rout in American shale exploration and production companies today. Management teams are looking for better commodity pricing and more economic certainty in order to deploy capital. At the moment, they have neither. And we could see production decline if prices stay low for a while. It will have its toll on energy service companies too if prices go down here into the 60s and stay in the 60s or below, as the break-even point for some of these offshore and onshore even are in the 70s and 60s ranges. So we could see a pullback in drilling activity even further from where we have today. And keep in mind, we have basically depleted our drilled uncompleted wells. They are a lot lower, the inventory, than what they used to be. We've pulled back on rig count. We're basically coming up to what I think is a bottom in the oil market at some point here. Could it go lower? Well, yeah, anything could go lower. I mean, we went negative in 2020. And we're at a ratio of about, I'd say about 46 or 7 barrels of oil per 1 ounce of gold, which historically is incredibly cheap for oil. Now, it could get a little bit cheaper. The momentum has been in favor of gold. The market conditions have been in favor for gold, and that could continue further in the I'll say short to medium term, and maybe gold still outperforms it for a little while. Very possible. I said, what do all these have in common? And I've got 4 clips up here. This is interest rates, the 10-year yield. It peaked in January, early to mid-January. It peaked and it started to roll over. That's right when Trump took office. We had a nice 3-hump consolidation, a breakout to the upside, and since Trump's taken office, him and Vicente have said we're going to try to get the 10-year yield down, and here it is coming back down. This is what they're saying. February 6th, very early. Vicente started to come out with. Vicente says Trump is focused on the 10-year Treasury yield and won't push the Fed to cut rates. So I don't know what they're doing in the background trying to get the 10-year yield down, but there is some ramifications if they're successful at getting the 10-year Treasury yield down. If they get it down, usually there's a correlation between yields and oil price. So they might try to get the 10-year yield down by putting downward pressure on oil price. That's the drill, baby, drill. There's all these things that they came out in terms of them talking about that they want to get oil prices down. So this here is oil prices. You can see that's when he came into office. We were basically getting a breakout in yields and oil prices. And we pulled back here in the short term for sure. And so has yields. We've also seen this disconnect of commercial inventory levels and what we consider to be fair value pricing. Fair value pricing from this level, you go upwards, it's about $90, $92, something on the lines of that. We're trading at under 70. So we're like $25 undervalued on the price. So since he's taken office, this is what we've seen, and I don't know if they're in the background doing something. I'm not exactly sure. If they're playing with paper futures markets or something like that, I don't know. But we're $25 undervalued, roughly speaking. Maybe it's 20 to 25 for commercial inventory levels. This disconnect started when he started being president. You can see the pullback there and the pullback in yields. And he's come out and stated that he wants to pull the 10-year yield down and that he wants to impact the oil price and the drill, baby, drill slogan and all that stuff. I don't know if there's a correlation there. A lot of the chart setups suggest that oil had a pretty good setup. With this tariff news that just came out, you can see that the 10-year yield dropped quite a bit. I'm kind of interested to see how this changes that dynamic, if it does at all. I'm not sure if it does or doesn't. I have to do a little bit of research on tariffs, I guess. I don't think it would destroy any dynamics there. We still have a lot of long-term trends in place that are favorable for oil to go higher. It's just the timing of it becomes a little bit in question with these tariffs just being implemented. Trump can stay retarded longer than we can stay solvent. I started laughing at that when I first saw that. It's pretty much true. Trump can stay retarded longer than we can stay solvent. I thought it was funny. Here's Kevin Bambro. He says, who rides uranium stocks down only to sell them in the morning here, which they're at a very cheap price. So what his opinion is, at the current prices that we're at, he thinks that they don't understand long-term macro because it only is getting better, which I agree with. That's the gold to Dow Jones, gold to SPX, all these different ratios, the sector fundamentals of uranium, the sector fundamentals of oil, they're only getting better as time goes on, in my opinion. People who didn't think they were overvalued at the past peak, they didn't understand value then and don't now. People who react in a panic to sectors and events that don't relate to nuclear power. People who are over-levered and getting their butts handed to them. That's who is selling, are these people. It says buying stock from the above groups of people is very profitable if you understand the long-term macro, understand value, understand the dynamics of the nuclear power sector, and aren't levered. Raised cash and are taking a long-term perspective. or at least a trade back to major moving averages, which are much higher than where we are today. So that's his opinion on URNJ, URNM, and the uranium space. And he's extremely bullish on the space. And these are the people who would be selling in this particular time. Moves up in commodity currencies against the dollar. This is another thing that is good for commodities. Previous commodity bull markets, we've seen commodity currencies outperform the United States dollar. That was the last bull market, this big up move. We had a 3-hump consolidation and a falling wedge before the big move and breakout. We also had a lot of sideways chop from about 2000 all the way to 2003. It was chopping for 2 or 3 years. So we had a lot of chop before we had the big run. We have another 3-hump consolidation. We've got another kind of chop sideways that started in 2001, 2022, or 2021, I mean. And we've been chopping sideways for a few years. One thing to notice, we're seeing strength, very strong moves in Canadian dollar outperforming the US dollar yesterday. We're also seeing that in the Brazilian real, a 3-hump consolidation and a falling wedge, a potential double bottom, and we're starting to move higher again in this ratio of real outperforming the dollar. And then we've got the Australian dollar versus the USD, a big downtrend back in the 90s and 2000s. We bottomed in 2001, 2002, worked our way on up during that commodity bull market. We have another consolidation. You can see we're squeezing in a falling wedge again, the 3-hump consolidation. We've got another hump and a sideways action. We have been outperforming yesterday for the Australian dollar versus the USD. So that is where I would be looking, is look for these currencies to outperform, which is going to help. It's more information and more data proving that we're going to be entering a commodity bull market. So these are all still good. I know that we went through this tariff, a lot of fear in the market. Some people are probably questioning their positions, saying, well, it went down a lot. Price doesn't drive narrative. The patterns do. The outperformance of certain currencies tells us about the market conditions. And I think the market conditions that are coming up are all still the same as they were before. Nothing's changed. Nothing has moved in an unfavorable way for us. Just looking at the debt that needs to be refinanced, and I was talking earlier about the 10-year yield and oil prices and the decline of the 10-year yield. I think it's being motivated by the debt that needs to get refinanced. I'm just going to read this real quick for everyone. This is what's coming up. It says the majority of U.S. government bonds that need to roll over in 2025 are concentrated in the first half of the year, particularly between January and June. According to available data, approximately $9.2 trillion in marketable treasury debt is set to mature in 2025, with around 70% of that amount, roughly $6.4 trillion, requiring refinancing during these 6 months in the first half. The front-loaded maturity schedule is driven by a significant portion of short-term treasury securities, such as T-bills, which have maturities of 1 year or less, as well as some longer-term notes and bonds issued in prior years that are now coming due. This aligns with broader estimates indicating that nearly $7 trillion to $9 trillion of U.S. debt will mature throughout 2025, with a substantial chunk weighted toward the earlier part of the year. The exact dates for these rollovers depend on the specific issuance and maturity schedules set by the U.S. Treasury, which conducts regular auctions to refinance maturing debt. For instance, significant auction activity is expected in April and May, as these months have been highlighted for large rollovers of short-term debt issued in 2024. However, the Treasury does not publish a single definitive majority rollover date, but rather manages this process through a series of auctions spread across the year, with the heaviest volume occurring in the first half of 2025. Maybe he is injecting fear and uncertainty, he being Trump, into the markets to try to lower interest rates. to try to spark demand for bonds. You could do that by creating a recession. You can do that by injecting fear and uncertainty in the market. And maybe he's trying to get the 10-year yield down so that they can restructure these short-term T-bills into longer, out there dated bonds, maybe the 10-year, to refinance. I don't know the exact motives behind everything, but this could be one thing that they're motivated to refinance all of this, and they are trying to create demand for bonds. And that is Besant and Trump that I'm talking about specifically. And that is basically when they come out and they say they want to lower yields, they want to lower the 10-year specifically. That's kind of what I'm using as evidence that they're trying to roll this stuff maybe into the 10-year if they're successful. Gold went up $60 in the last 2 hours. They are going to crash the stock market to try to stop gold. The bankers are scared. I think there is some of that going on in the markets. I think they're trying to do a couple of things all in one shot. Here is my guess. I find it highly weird that gold crashed post-market, pre-market with the dollar going down and interest rates going down and the yield curve uninverting. That is all generally positive for gold. When the markets did open, we saw gold shoot higher by $60 in the last 2 hours. It had a big move to the upside. So are they trying to use tariffs and use that as a cover to kind of hit down silver and gold, platinum, palladium, oil, and try to get interest rates down? Very well could be the potential motives behind all of this. It might be they need to refinance the debt. Well, let's try to control the price movements of gold, silver, oil, and all these different commodities. Maybe we can push them down in the short term as well. I don't know if that's the case. Maybe it is, maybe it isn't. But it is a little bit weird that gold was down, even though all the market conditions were tailwinds for it. Rock Bottom Entry says, check the level 2. Retail accounts panic selling into institutions. Today is a buying opportunity. Commodities gapping down and getting rapidly bid higher. So they were gapped down in the morning, and some commodities went up. Specifically, gold was up quite a bit. And there's other commodities that were going up throughout the day. Other areas had fared a little bit worse than others. Here's David Burrows. He says, it appears the train has left the station for destinations unknown. We are not there yet. And this is gold relative to QQQ. This is what I use as an indicator for a commodity bull market that is coming. We are shifting into this commodity bull market as we speak right now. Gold does really, really well when interest rates drop and we get a slowdown in the market. That's when gold outperforms. It's considered, quote, the safe haven asset. QQQ is an asset that performs well in a recovery phase of real estate. When you move from a recovery phase to an expansion phase, you generally go through what's called a mid-cycle wobble. The mid-cycle wobble is we experience a slowdown in the middle of the cycle between recovery and expansion phase. That slowdown can impact a lot of the assets. And in that slowdown, gold starts to outperform QQQ, or gold starts to outperform technology stocks. And that's exactly what we see. This is a bottoming, and gold is starting to outperform technology. So it says if the fear is that gold shares will be sold as a source of cash to create liquidity for margin calls, it assumes that they are well owned, which they are not. Likely, the reason gold is now outperforming Bitcoin, which is owned largely by the same folks, long tech. I don't know about that and what they're talking about there, but this is a leading indicator. And this leading indicator is moving up, which is beneficial and more evidence for a commodity bull market that we are in now. We are in it, and it's official that we're going into an expansion phase. The OPEC plus production quota increase is to compensate for the already overproduction for some of the cheaters. And I know some people are worried about OPEC is bringing barrels online. So they say that's bearish. If you look at history, when OPEC brings barrels back into the market, it's generally a bullish thing. And they do that because they see the market is tightening. There's more demand for oil. Some of this increase, OPEC's been cheating. Some of the countries have been cheating their quotas, and now they're just kind of writing those quotes to what the production level really is. Now, that's also a little bit scary because if they're cheating on production and we still have drawdowns with overproduction or overproducing to the quotas, they may not have as much spare capacity as what most people think. So, again, we'll see what happens. Gold miner ETF GDX is now positive on the day. You cannot ignore the relative strength in mining stocks anymore. Every sell-off is getting bought. Something's changed. That's your market conditions. That's the gold price outperforming QQQ or technology. Another thing that can also occur is we might see an outperformance in precious metals and the mining companies before, let's say, some of these inflation-sensitive sectors like oil, fertilizers, and stuff like that. But I will say a lot of those other sectors are putting in bottoms. They look like they're putting in bottoms. Some people will try to debate that. Well, let's get the charts out. We can debate the charts and see what they look like. But to me, a lot of them are putting in double bottoms. We've seen double bottoms already placed in some of the sectors like copper and whatnot. The big question that's still in the air is, are these tariffs going to change any of these market dynamics? Because we did go from very little tariffs to a lot larger tariffs. If they stay in place, does that change the dynamics? Could we get a short-term slowdown because of it? Those are all questions that I think people are trying to figure out right now. HFI research says nothing like the oil market where in 1 month rally is wiped out in one day. And that is pretty rough. Silver's down 7%, while SILJ is down 1.25%. Spectacular. And that's some of the positioning I think is going on. A lot of these guys, what they do is they hit the commodity really hard, and then they position in the equities. That is what could be going on for the next maybe week or two even. Maybe they're going to hit silver down, hit it hard, so they can get positions in the equities and scare people out of their positions. They generally use fear. They may gap in the morning. They may gap it down and then buy it up throughout the day to basically get the volume up so they can buy the shares in volume. Simple logic, stock market tanking, you move money to bonds as a safe haven, but the United States dollar is dropping. Your low bond yield will not protect you from dollar weakness, so you buy real things like gold. This logic is understood by many. We are seeing capital reallocation in progress, says David Lee, and I think that's completely true. Why would anybody want to own bonds? And that's another thing that I find really weird. We saw this big gap lower in bonds. Who do you think's really buying bonds? Do you think that was legit demand, or did they do that on purpose to try to create fear in the market where people get scared and try to run to bonds? I think that's what they're trying to do. Josh Young says policy failures have consequences. Capricious tariffs will likely induce money printing and stimulus around the world. Knocking oil prices below the marginal cost of supply reduces drilling activity and incremental supply, eventually driving prices much higher. That's what will eventually happen. That's correct. Tariffs are taxes. Tariffs are regressive taxes. Tariffs are distortionary regressive taxes. Tariffs are distortionary regressive taxes that raise prices for U.S. businesses and consumers. That's completely true. Peter Schiff says Trump's tariffs are illegal. Congress delegated the president the power to impose reciprocal tariffs. But Trump's tariffs are reciprocal in name only. They are based on a bogus formula that attributes any nation's trade surplus to tariffs, even if tariffs are low or non-existent. I don't know the legality of it. I really don't. Maybe they're illegal, maybe they're not. If they are illegal, then we should do something about it. I mean, obviously, we should be following the Constitution, and if we need to vote on it, then that's what we need to do. But I don't know. That's his opinion. John Arnold says, imagine being a multinational trying to decide whether to respond to the tariffs by greenlighting a new plant in the US that is more expensive and won't come online for years without knowing what tariffs will be in effect in 4 years or even in 4 months. And that's that uncertainty. Uncertainty is a killer because when you try to plan for long-term plans, they can't really do it. So they probably won't greenlight it. They'll probably say, we'll hold off and make sure that, that whatever's going through goes on through. Freight futures AM update. Dry bulk was down 4 and 5% between Cape Max and Panamax. Tankers were flat, VLCC and Suezmax. Here's also something that David Burrows is seeing, and I see the same thing. It looks increasingly likely that the initial announcement of tariffs marked another crisis low for the Canadian dollar. We touched the same lows as peak COVID and the bear market in commodities as China sold off in 2015. Here's the three lows: 2016, 2020, and 2025. And if you go back and look at the price of gold and some of the mining companies, they did incredible in 2016, 2020, and where we are today could be another setup where the gold miners and gold do very well, and silver. But when I remember 2016, we had a big move in 2016 from that bottom low, and I played that one. I also played the bottom of 2020. I'm playing this one too in the bottom of 2024, 2025. But yeah, the Canadian dollar outperforming is a big deal when it comes to commodities. It's another piece of data that we can use to show you that the commodity bull market is alive and well. Kevin says, looks like I was at least a day early. He's talking about his purchase of URNJ. Will continue today as I think the tariff-related selling will mark a major bottom. Sell the rumor, buy the news is in this case. I think that's a pretty good idea. Joel Greenblatt says you can't be a good value investor without being an independent thinker. You're seeing valuations that the market is not appreciating, but it's critical that you understand why the market isn't seeing the value that you do. That's pretty good. Another one from Joel. He says, if you can't step back and take a longer time horizon, that is the big secret. So if you can step back and take a longer time horizon, that's the big secret. Charlie also says, if you invest the way people gamble at casinos, you're not going to do very well. It's the long-term investment that works best. So all these guys they're all long-term investors. That's what the game taught them. That's what they turned into. And that's what's successful. That's what I've adopted as well. Spencer says, Elon realized Doge was going absolutely nowhere. He realized his companies were getting trashed over his incorrect decision to get involved in politics. He realized Republicans are going to keep spending, just like Democrats do, no matter what. He smartly cut his losses here and is hopefully going back to what he does best, building amazing businesses. Good luck, Elon. And very well, that could be the case. And I do think Republicans are probably going to spend quite a bit too. Every single Republican or Democrat, they seem like they all spend a lot. So are we going to get more deficit spending? Probably. That's probably my guess. Vicent just lost all my respect, says Lance Robert. He says he's got to be an idiot if he believes the after-hours plunge in the market has nothing to do with the tariffs. And I agree. That seems pretty... The tariff news comes out, everything plunges like massively. That does have a correlation. A lot of the times when you can't find anything in the market and things are kind of flat or they're barely up or something, they just make that news up. But if you release news and everything tanks like 6, 7, 8, 9, 10%, yeah, that's definitely the driver of it. Eric Nettle says, big win for Canadian energy stocks this afternoon as our base case long argued that energy would be exempted from U.S. tariffs has come to fruition. Yeah, so a lot of these Materials, commodities are exempt, including energy. The world doesn't need Americans to buy stuff. Americans need the world to make stuff. There are consumers all over the world eager to buy what Americans can no longer afford. As the US dollar falls and their own currencies rise, that is precisely what will happen. And that's exactly what we were just looking at. Canadian dollar, Australian dollar, the commodities, Brazilian real. Yeah, that's also going to impact the purchasing power of our dollar and what we can purchase. Mexico's finance ministry estimates crude oil production 129,000 barrels per day below target. They are losing production. They've got decline rates. Not looking good for Mexico. Trump just said that in 1913, for reasons unknown, they established the income tax. The reason is well known to almost everyone but the Trump administration. The income tax was imposed to tax the super rich, to replace the tariffs that were paid by the middle class and the poor. Another reason why it went in is that's when the Federal Reserve came into power was 1913. And they need to pay the interest on the debt because before that, there was no interest on the debt. So now we've got an entity creating money from nothing and charging interest on it, which is the design of the system. And that's no good. Jordan Roy Bryn, he says, gold has broken out against conventional assets for only the fourth time in 100 years. 2008 was the outlier, but most assume it was the norm and therefore expect a repeat. Gold and gold stocks trended higher throughout the other three worst bear markets of at least of the last 100 years, most notably 73 to 74 and 01 and 02. It's because these breakouts occur at a time when majority owns stocks, bonds, and not gold. It marks a secular turning point and capital shift during the downturn. This negative correlation or divergence is actually a prerequisite for a real secular bull market in precious metals. There was no secular change in 2008, and precious metals were widely owned as it was 7 years after a secular change. So each one of these secular changes, the early 70s, the early 2000s, and now the mid-2020s, those were all commodity bull markets. And as we have broken out of gold versus the 60-40 portfolio and gold versus the S&P 500, that is more information and evidence that we are entering the commodity bull market. Gold is the one that leads because it behaves first because it's a safe haven asset. That's that slowdown in the market. As it outperforms, we will eventually see oil and all of these other areas start to outperform along with it. Silver, platinum, all of them. So it's coming, and we've broken out with gold versus these other asset classes, and this is the beginning of the move. But that's what I've got for today, guys. We're going to end it there. Give me a thumb up for the content. Subscribe to the channel. Subscribe to the website if you'd like. Use that special coupon code if you'd like. We've got a question and answer session coming up on Sunday at 5 p.m. Mountain Time. So I'll see you guys there. We'll talk about whatever you guys want. There's been some questions that have been forwarded to me already, so I've got those documented, and we'll get them all answered on Sunday. All right, guys. We'll catch you later. This is Finding Value.